Ever looked at a company's financial statements and found yourself wondering, what exactly am I looking at here and who even put this together? Well, today we're giving you a bit of a shortcut to understanding a crucial and, yeah, often misunderstood financial service. Welcome to the deep dive. Our mission today is to pull back the curtain on something called compilation engagements. We're going to break down, the core components, the responsibilities involved, and the reports that come out of these things. Our goal, to extract the most important insights from our sources, make it really crystal clear for you so you can look at these documents with, well, total confidence.
And this really is key for anyone trying to make sense of financial information quickly and thoroughly. There's some surprising nuances here that once you grasp them, will fundamentally change how you interpret those numbers. It's all about understanding what you're truly seeing.
So with that crucial distinction in mind, let's dig into the nitty-gritty. At its very core, what is a compilation engagement?
Okay, think of a compilation of financial statements as a service where an accountant basically lends their specialized expertise to help management present their financial information. The big takeaway here is that they're organizing the numbers, making sure everything's in the right place format-wise, but they're not checking if those numbers are accurate or complete. It's kind of like hiring a copy editor for a book. They'll make sure the grammar and formatting look good, but they aren't fact-checking the story itself.
That's a great analogy. So what makes it different from, say, an audit or maybe a review where an accountant does actually verify things? Why is this word assurance such a big deal here?
It's the critical difference. A compilation is explicitly not an assurance engagement, period. This means the accountant isn't required, under the standards, to verify the accuracy or completeness of the information that management provides. They also don't gather evidence to express an opinion or a conclusion on the financial statements. The entire focus is on proper presentation, making sure it looks right according to the accounting framework, not necessarily that it is right in substance. So you're getting a clear, well-organized financial picture, but it's not a verified one in the same way an audit or review would be. Big difference.
Okay, here's where it gets really interesting, I think, for anyone involved with a business, whether it's large or small. Before any numbers are even touched, there's this crucial first step, the engagement letter. It's essentially the rule book for the whole process, right? So what's actually inside this foundational document?
Yeah, the engagement letter is absolutely paramount because it formalizes the understanding between the accountant and the client management. It's a signed, written agreement that sets the stage. It covers a few essential things. First, what exactly are we doing here? The objectives. For example, preparing financial statements for, let's say, Sarah's small business in accordance with GAAP. Generally accepted accounting principles, the standard financial language based purely on Sarah's information, and assisting in their presentation without providing any assurance. Clear goal. Second, and this is often the surprising part for many people, it lays out management's responsibilities. What's kind of astonishing here is that even though the accountant is putting it all together, management actually carries almost all the risk and responsibility for the underlying data. They're on the hook for selecting the right financial reporting framework, like GAAP. They're responsible for preparing and ensuring the fair presentation of the statements themselves and for designing and maintaining the internal controls that help prevent errors or fraud. And crucially, management must provide all financial records, and they're the ones responsible for the accuracy and completeness of everything they hand over, all the documents, the explanations, significant judgments. It's a bit like hiring a builder for your house, but you're still responsible if the foundation you poured isn't level.
Wow, okay, so the buck really stops with management on the data itself.
Absolutely. Third, the letter clarifies what the accountant will do. They'll conduct the engagement following the Statements on Standards for Accounting and Review Services, or SRs. That's the professional rule book for these services, and stick to the AICPA's Code of Professional Conduct, their ethical guide covering integrity, objectivity, due care, etc. And it hammers home again what they won't do: won't verify accuracy, won't gather evidence for an opinion, won't express an opinion or conclusion, and won't offer any assurance. Fourth, it states the limitations clearly. This engagement can't be relied upon to uncover errors, fraud, or any illegal acts. And finally, it identifies the specific financial reporting framework being used, like GAAP, and gives an idea of the expected format of the report. That clear, signed, written agreement is the bedrock. It sets expectations for everyone, preventing, misunderstandings later on.
Right. So when Sarah decided to get her books compiled, this letter for her company, maybe ABC Company, would clearly outline that it's for her balance sheet, income statement, statement of equity, cash flows for December 31st, 20XX, and includes the related notes. It's all about total clarity from the very start.
Precisely. Leaves no room for doubt about the scope or the responsibilities.
Okay, the letter's signed, the mission is crystal clear. Now, what does the accountant actually do during a compilation for Sarah's business? What are the practical steps involved?
Right. So once that understanding is established via the letter, the accountant has specific performance requirements under SARs. First, they need to have adequate knowledge of the accounting principles and practices for Sarah's specific industry. This ensures they can actually compile her financial statements in the proper form. Now, they don't have to be an expert in every single field coming in, but they're responsible for gaining that necessary knowledge if they take on the engagement. Second, and this is a critical safeguard for you as a user of these statements, before they issue any report, the accountant must read the compiled financial statements. They're basically looking to ensure the statements are appropriate in their overall structure, the format, and free from what we call obvious material errors.
Obvious material errors. What does that mean exactly?
Good question. It means things like clear mistakes in arithmetic, clerical slip-ups, or presentation choices that are clearly inconsistent with the accounting framework being used. They aren't digging deep like an auditor, but anything that just jumps out as wrong needs addressing. Third, what happens if the accountant becomes aware of something potentially problematic? Maybe signs the company might not be a going concern, or issues with legal compliance, or significant subsequent events after the period end. Well, they must request management to consider the effect on the statements, then they evaluate management's conclusions on that, and consider how these matters might affect the compilation report itself. They can't just ignore red flags they stumble upon. And fourth, this is important, even though they're not required to verify information, if the accountant discovers that the information Sarah provided is incorrect or incomplete or just generally unsatisfactory, they can't just shrug. They must try to get additional or corrected information from her. And here's the real line in the sand. If Sarah refuses to provide that necessary information, the accountant must withdraw from the engagement.
Wow.
They simply cannot put their name on a report associated with financial statements they know or strongly suspect are based on dodgy data.
So, if the client is giving them sketchy ingredients, the accountant basically has to say, sorry, I can't cook with this. That really underscores the reliance on management's info, which raises an important question. Why is documentation so crucial in all of this? It sounds like maybe a lot of paperwork.
Yeah, it might seem like just paperwork, but think of documentation not just as busy work for the accountant, but as a critical safety net for everyone involved, including you, the user, indirectly. It's the proof, essentially, that the accountant followed the rules complied with SRs. The absolute required basics are the engagement letter we talked about, a copy of the final financial statements that were compiled, and a copy of the accountant's compilation report. Beyond that, it's highly recommended, though maybe not strictly required in all cases, to document any significant findings or issues encountered. For example, if the statements initially seem materially misstated and what steps were taken to get them corrected, or communications with management about potential fraud or noncompliance. This paper trail proves exactly what was agreed upon, what the accountant did, and what was found. It provides a clear record if questions ever arise later about the numbers or the accountant's role.
Okay, that makes sense. It's protection and proof.
Yeah.
All right, the work is done. Sarah's financial statements are compiled. What does the final report actually look like? This is the piece the user ultimately sees and has to interpret, right?
Exactly. The compilation report is the key communication tool. Its purpose is for the accountant to clearly communicate the extent of responsibility or lack thereof that they took for those financial statements. It's a formal written document with a very specific standardized structure.
So what's inside a standard compilation report? What are the absolute must-haves for every client like Sarah?
Okay, a standard report must include several key elements. First, a statement that management is responsible for the financial statements. That's up front. It needs to identify the specific financial statements that were compiled, the entity's name, like Sarah's Small Business, and the period covered by the statements. It must state that the compilation engagement was performed in accordance with the SAR statements on standards for accounting and review services issued by the AICPA. And here's that crucial repetition we keep mentioning because it's so important for the user to understand. It explicitly states that the accountant did not audit or review the financial statements, and consequently, they were not required to perform any procedures to verify the accuracy or completeness of the information provided by management. And therefore, the accountant does not express an opinion, a conclusion, nor provide any form of assurance on those financial statements. That disclaimer is central. It concludes with the accountant's signature, their city and state, and the date of the report. Oh, and one more practical thing. Each page of the financial statements themselves should be marked. See Accountant's Compilation Report, or something similar.
That marking is important. It links the numbers directly back to the report's context.
Exactly. So users immediately understand the limited nature of the accountant's involvement.
Okay, that's the standard report. But you mentioned sometimes things aren't standard for a business like Sarah's. When might we see those additional paragraphs? What kind of flags are those for us?
Ah, yes. These additional paragraphs are really important signals for the user. They tell you something unique or different about these particular financial statements. First scenario. If the statements are prepared using a special purpose framework, this means they're using a basis of accounting other than GAAP. A common example is the tax basis of accounting, or maybe cash basis. In this case, the report will have an extra paragraph describing the framework, referring you to a note in the financial statements that explains it more fully, and stating that this basis might not be suitable for other purposes. It's a flag saying, hey, these aren't your typical GAAP statements. Understand the rules are different.
Okay, so different rules, different basis. What else?
Second, and this one is quite interesting, is when there are omitted disclosures. An accountant can, believe it or not, compile financial statements that intentionally leave out substantially all the disclosures normally required by the framework, like GAAP footnotes. However, this is only allowed if two conditions are met. One, the statements themselves, the numbers, are otherwise presented okay according to the framework, and two, the omission of the disclosures is not, to the accountant's knowledge, undertaken with the intent to mislead users. If those conditions are met, the accountant must add a paragraph to the report clearly indicating the omission. It'll say something like, management elected to omit these disclosures, and if they were included, they might influence the user's conclusions. And critically, it states the statements are not designed for those who aren't already informed about such matters.
So a sort of user beware if you don't know the full story behind the numbers?
Pretty much. It's often used for internal management purposes, where everyone knows the context, but it's a big flag for external users. The third scenario needing an extra paragraph is when there are known departures from the applicable financial reporting framework. Let's say Sarah's statements are supposed to be GAAP, but she decided to report her land at its current appraised value instead of its original historical cost, which GAAP requires. The accountant must disclose this departure in a separate paragraph in their report. They should describe the departure and, if management provides the information, disclose the monetary effect on the statements like equity would be X dollars lower if land were stated at cost. Now, a critical point here. The accountant cannot just modify the standard report language to say the financial statements are not in conformity with GAAP overall. That would be equivalent to giving an adverse opinion, which is something only an auditor can do after performing extensive audit procedures.
Right, because they haven't done the work to make such a strong negative conclusion.
Exactly. The compilation accountant points out the specific known departure, but doesn't give an overall thumbs down. It's more like saying, I've organized these books according to the rules, except for this one specific thing management did differently, and here's what it is. Finally, an additional paragraph is required if the accountant is not independent of the client. You might think independence is always required, but for a compilation, it's not. An accountant who lacks independence, maybe they have a financial interest in Sarah's company, or a close family member works there, can still perform a compilation and issue a report. However, the very last paragraph of the report must state simply, we are not independent with respect to ABC Company. They can choose to disclose the reasons why they aren't independent, but they aren't required to. If they do list a reason, though, they have to list all the significant reasons.
That independence disclosure seems really important for a user trying to assess potential bias.
It's a crucial piece of context, definitely.
Okay, so if you're looking at Sarah's compiled statements, these potential extra paragraphs, special framework, omitted disclosures, departures, lack of independence are your cues to dig deeper or just understand specific caveats. Now, how does a compilation then compare to something called a preparation engagement, which sounds, somewhat similar? What's the key pass-key differentiation there?
That's an excellent question, and yeah, it's a common point of confusion because the actual work performed can feel very similar. The accountant still uses their expertise to help put the statements together based on client info. However, there are two key differentiators that really separate them. First, compilations require the issuance of that formal report we just discussed, communicating the accountant's role and lack of assurance. Second, compilations require the accountant to consider and determine whether they are independent of the client, and if not, to state that in the report. Preparation engagements, on the other hand, do not result in the accountant issuing a report. And perhaps surprisingly, the accountant performing a preparation service is not required to even consider their independence. So it really comes down to whether a formal report is needed, often for external parties like banks, and the requirement to address independence. Preparation is often just for management's internal use when no report is necessary.
Got it. Report versus no report, and independence consideration versus no independence consideration. That clarifies it. So, what does all this mean for you, the listener? You now know that when you see that accountant's compilation report, you're looking at a very specific kind of service. More accurately, a very specific lack of assurance attached to those financial statements. It's definitely a valuable service for management, helping them get their financial data presented in a structured, professional way that follows accounting rules, but it comes with really clear boundaries regarding verification and accuracy checks.
That's precisely right. The core takeaway is that compilation engagements are about applying accounting expertise to present financial information clearly and appropriately, based on what management gives the accountant. It is not about verifying the underlying accuracy or completeness of that information. Understanding this fundamental distinction really empowers you to interpret financial statements with much greater clarity and, frankly, confidence. You now know what questions to ask and, maybe more importantly, what assumptions not to make when you encounter a compilation report.
And remember, being truly well informed isn't just about getting the data points, it's about understanding the context, right? The who, what, and why behind those numbers. Today, we've unpacked a pretty significant piece of that puzzle.
Absolutely. And maybe a final thought to leave you with. In a world just flooded with data and information, maybe knowing what kind of information you're truly receiving, its source, the process behind it, and especially its limitations, is perhaps the most valuable skill of all. So thinking beyond compilations, what other financial documents or reports do you encounter regularly where understanding the backstage process, the rules of engagement, could actually change your perception or your decisions?
That's a great question to ponder. Keep diving deep, keep asking those questions, and we'll see you on the next deep dive.